Okay, so today we're going to start off talking about optimal income taxation, so finishing up the end of lecture 4, and then we'll go ahead and dive into corporate taxation. Everyone's jazzed, right? I know part of you is sad because you think this is your last tax lecture because the midterm's coming up. Don't worry, we save tax reform for after the midterm, and that will be your last tax lecture. Okay, so optimal income taxation. I don't want to say too much about this, but I want to cover a few things. So when we think about optimal income taxation, what we're really asking is, what is the optimal set of marginal tax rates for the different brackets of income, such that we're sort of minimizing deadweight loss, but also taking equity into consideration. So in particular, I want to think about, so right now we have 6 sort of income brackets, right? We have 6 different income brackets and 6 marginal tax rates. I want to think about increasing the marginal tax rate on, say, the 3rd income bracket, right? So we have the 10% bracket, the 15% bracket, the 25% bracket, the 28% bracket, the 33% bracket, and the 35% bracket. Is everything okay? Yeah. It's chaotic. Sorry, for a minute I thought something was like crazy, like I'd ketchup all over my face or something. I couldn't tell. Okay, good, as long as that's it. Okay, so I want to think about the thought experiment of increasing tax rates, so increasing the marginal tax rate on the 3rd income bracket. So let's say you're in a bracket above that. Let's say you're in the 4th, 5th, or 6th income bracket. Is that going to change your incentives for labor supply in terms of substitution effect? So we increase the marginal tax rate for the 3rd income bracket. You're in a higher tax bracket. You're in the 4th, 5th, or 6th income tax bracket. Does that impose a substitution effect on you? No. It doesn't change the returns to your marginal hour of labor, right? But what does it do? It increases your average tax rate, right? Because part of your income will be taxed at a higher rate. That's the inframarginal effect. Those people, in fact, will be encouraged to work only. They're poor, right? We're taking more of the money away, so they're poor, so they're going to want to work more. So the inframarginal effect, right, on everyone in a tax bracket above the tax bracket we're touching the marginal rate of, will only have an inframarginal impact. We're only changing the substitution effect only creating substitution effect on workers whose marginal dollar of income is in the bracket we're adjusting the marginal tax rate of. So there's this trade-off, right? We can always raise more revenue by sort of increasing tax rates on lower tax brackets. But what's the problem with that? Why is that not a great place to increase tax rates? Does that help us with progressivity? No, it reduces the progressivity of the tax code. So if we care about progressivity, we want to sort of, increasing marginal tax rates on lower brackets may have efficiency benefits. There are these equity concerns where the progressivity of the code is reduced when we increase marginal tax rates on low brackets. That's the first thing I wanted to touch on. Second, so there's this thing called the Murlis Model. And the Murlis Model has this very simple conclusion that suppose we have 2 kinds of people, high ability people and low ability people. We want to create a tax system where we're going to tax the high ability and make transfers using that revenue to the low ability. In fact, the Murlis model concludes that the optimal kind of tax is a, hey, you're high ability, you owe the government money kind of tax. Doesn't depend on what your labor supply is, doesn't depend on what your income is. If you're high ability, you pay a tax. You pay a flat tax, regardless of what you sort of do with your time. It's called a lump sum tax. It's the ideal tax, right? Because we're taxing those who are just more productive, who have more resources given to them in the sense of their high ability, and we're sort of making transfers to the low ability because underlying this whole model is some sort of social welfare function that's somewhat utilitarian in nature, right? That we sort of want to make transfers to the low ability. This is a great theoretical conclusion. It's actually more powerful than I'm sort of suggesting with my tone of voice sometimes, right? It is a powerful conclusion, but it's not so easy in the real world, right? We've talked about how lump sum taxes are really hard to apply, right? It's very difficult for us to say, regardless of your income this year, your tax bill is X, right? That's not something we find very practical. Second, the Murlis model has this very nice setup where there are 2 kinds of people, high ability and low ability, and everyone's got a tattoo on their forehead that tells everyone exactly what type they are, right? In life, when we see someone's income, if someone is high income, there's probably 2 things going on, right? They probably are relatively high ability, given the distribution of people, right, if you're very high income. But it also is a function of effort, right? And we can't look at sort of your external characteristics and disentangle ability from effort. So that sort of makes using lump sum taxes that are based on ability sort of a non-starter, right? And the IRS can't sort of go ahead and use the Murlis model because of the sort of disentanglement issues between ability and effort. But what we can do is sometimes, one way to think about optimal income taxation is that if we tax income right, we're going to be distorting the returns to effort. So we'll get less effort potentially. But if we can find some other tag, a tag that's correlated with ability, but is not correlated with effort, that would be a great thing to base taxes on, right? We don't really have such an instrument, but we could think of things that it could be, right? Maybe if you come from a well-educated set of parents, or if you come from a wealthy background, you were given certain advantages, right? And that might be some proxy for ability. But this is sort of the notion for the Murlis model that we can take into optimal taxation, is that in a world in which we can't separate ability from effort, taxing the outcome of a combination of ability and effort will reduce the returns to effort and reduce the amount of effort we get in the economy. So what we really want to look for is some kind of tag for ability that is not correlated with effort. We have yet to find one, but if we find one, this is the way to go. This is how to apply the Murlis model. And the last thing I want to talk about is that when we think about sort of the optimal income taxation and how it relates to efficiency and vertical equity, we want to think about how ability is sort of distributed in the population and how elasticity is distributed in the population. If high ability people are really low elasticity, that makes them a great target, right? Even if their income, their high income, is a function of both ability and effort, if their elasticity is very small, i.e. their responsiveness to, they don't exert less effort necessarily when you tax them more, then high income people are a great source of revenue, right? Because high income people, we think it's ability and effort. If they don't really decrease their effort in light of taxation, then that's a good place to sort of levy taxes. On the other hand, if high-income people are extremely elastic when it comes to exerting effort, increasing taxes on that group of people will have more of a deadweight loss, right? It will be more distortionary. So that's sort of when we think about this, we're trying to trade off the elasticity part of this with the part of where people are in the ability distribution, and we're trying to kind of come up with a way to sort of tax those to whom much is given more heavily without actually decreasing the effort those who are very productive put forth into the economy. That's sort of the game of the optimal income taxation. And in general, the greater the inequality of ability in the population, the more we want to be redistributing towards less ability, and the optimal tax policy will be more redistributive in these ways. Okay, and the last thing I want to talk about when it comes to optimal income taxation is there's a lot of talk about optimizing the tax rate such that we're maximizing revenues, right? That's sort of part of the name of this game, part of this game. And I've talked about previously that if we suppose we had a tax rate of 0, how much revenue would we raise? 0. If we had a tax rate of 100%, it's likely that we'd raise very little revenue as well, right? Because if every dollar you earn is going to the government, it's not clear many people would work, right? Most people would choose to not work. So at either 0 or 100%, we have less revenue than we would have at some in-between tax rate. We have 0. So there is some tax rate between 0 and 100% at which we're maximizing the amount of revenue, in the sense that each dollar of earned income is giving us a good share of revenue, but at the same time we're not distorting labor supply to the point that we're getting less output to tax, right? That's the trade-off. The higher the tax rate, we get more tax revenue per unit produced, but we're getting less production because the tax rates are so high. There's some optimal level in between. So sometimes it's argued that if we go ahead and cut taxes, these tax cuts could pay for themselves, right? We may reduce distortions in the market sufficiently such that the revenue we raise on the smaller base, the revenue we raise at a lower rate on a larger base is more revenue than we were raising on with the smaller base and the higher rate. Right? That's the argument about tax cuts paying for themselves, right? Is that when we reduce the tax rate, we grow the base, and that combination of a low tax rate and a broader base will give us as much or more revenue as the pre-tax cut, small base, higher rate combination. That's the argument. And it clearly must be true that at some level of taxation, this would be true. If tax rates are at 95%, cutting taxes may well give us as much or more revenue. But for the kinds of tax rates we see in the US economy today, this is not true. Tax cuts do not fully pay for themselves. And this is a piece from the Wall Street Journal back in 2003, right after the passage of the second tax cut of the early 2000s. And it says, do tax cuts pay for themselves? That's been the hot debate of American political economy for the better part of 3 decades. But it ended last week with a whimper. According to CBO simulations, in no case does Mr. Bush's tax cut come close to paying for itself over the next 10 years. The great debate launched by Mr. Laffer, that's the Laffer curve, that's that whole taxes are 0 revenue is 0 at 0 and 0 at 100, and there's some combination that's optimal, right? There's something in between that's optimal. That's the Laffer curve. So it says, the great debate launched by Mr. Laffer and his napkin in 1974, he drew it on a napkin initially, is for the most part over. Certainly, tax cuts can improve overall economic growth, and certainly revenues may rise as a result. But at the current levels of taxation, those effects are relatively small. There is no free lunch. Cutting taxes does not give us more revenues. They do partly pay for themselves, and one of the back of the envelope calculations that some folks have done, Greg Mankiw has done, and others have done, suggests that at the current levels of taxation, approximately across income sources, it's approximately 25%. So a tax cut pays for 25% of itself. I.e., if we cut tax rates by 10%, we would get 7.5% less revenue, because 25% of that comes back to us in the form of a larger tax base. That by destroying the market less, we get more supply, we get more production, we get more labor supply, we get more production, we get more of the base, and so our lower rate gives us some of the revenue back, but not all of it, right? So 10% tax cut will give us 7.5% less revenue. So they partly pay for themselves, 25%. Okay, that's all I wanted to say about optimal income taxation. Any questions about income taxation? Yep.
So
Matt.
Yes.
Awesome.
That takes into consideration less taxes will expand businesses and promote employment. And
Exactly.
Better for social welfare.
Yeah.
Or like that idea where, so the base includes all of that?
The back of the envelope calculation is a little, what's included, think of it as the labor supply margin and a few other margins. Not every margin, but some margins. We could sit down and come up with more that are not in this back of the envelope calculation. It's sort of what we think of as the direct impacts that we could get in the short run, right? Are there questions? Okay, let's go ahead and delve into corporate taxes. So today we're going to talk about 4 aspects of corporate taxation. We're going to first just talk about sort of the basics of corporate taxation. We'll move into the incidence of the corporate income tax. We'll talk about 2 behavioral impacts of the corporate income tax. One is the effect of the income tax on investment behavior, and the second is on the composition of financing, how corporations finance their investment activities. And finally, I want to talk about the treatment of international corporate income by the US. Okay, so we've seen a chart like this earlier. So this is the chart of corporate income tax revenues as a share of GDP over a long period of time, right, starting in 1945. What's been added in are these gray bars, these gray vertical bars, which represent recessionary periods. So times in which the economy was shrinking. Just quickly looking at this graph, does it look like corporate tax revenues are pro-cyclical or counter-cyclical? Basically pro-cyclical, right? Yeah, there's a little bit of a lag, but or a little bit of a lead rather, but it's basically cyclical. But what's the major conclusion you would draw from this sort of trend over this long time period? It's going down as a share of GDP, right? We get less and less tax revenue from corporate income taxes than we used to, and it's going down over time. Excellent. So what are corporations? Let's start here. So this graph is striking, right? It's an interesting graph, and there's a lot of stuff that helps to explain what's going on. We'll talk about some of them today, and I think people are still coming up with new reasons too. So if you guys have ideas, I'd love to hear those too. Okay, so let's first talk about what is a corporation. When we talk about corporate, so firms, right? Firms, organizations that produce goods can take 2 organizational forms. There's the traditional C corporation. They give us roughly 75% of national corporate revenues. In this case, in the case of a C corporation, income earned by that corporation is subject to the corporate income tax. And when it's actually distributed to shareholders after sort of the corporate income tax has been paid, some of that income is distributed to shareholders in the form of dividends. In other cases, shareholders sell shares and get capital gains. It is then taxed again at the individual level, right? Okay, so that's the first form of organization, the C Corp. There's a whole host of other organizational forms, including the S Corp and partnerships and sole proprietorships. In the case of these types of firms, right, firms organized in the second set of categories, income is not taxed at the corporate level. Instead, the income each period, so each year, whatever income is earned, most of that must be sent out to the shareholders of the of the firm or of the partnership, right? All the partners must get their share of income each year and pay individual income taxes on that income. Cash or money cannot be stored, earnings cannot be stored in the firm. They can't be retained by the firm. It has to be sent out every period. You could have some small amount of cushion, but not more than that. It's a minimal amount. Virtually all income is sent out to the shareholders or partners every period in this type of organization. We're going to be talking about corporations of the first form, incorporated corporations, C corps. So when we talk about this decline in revenues, one of the explanations is that the C corp organization has gotten less and less popular over time. There was a piece by Bruce Bartlett in the New York Times blog the other day. I'll put a link up to it on the website, giving us some numbers actually about how C corps make up a smaller share of total firms today than they did in 1986 and 1982. It's a declining fraction. So we see more and more of these kinds of firms, fewer of these. And so that's part of it, right, is that we're sort of levying the corporate income tax on a smaller share of firms, right? More firms are organized like this. That's part of it. I want to give you a very basic overview of the structure of the corporate income tax. The way the corporate income tax works is that the income of the corporation is the difference between revenues and expenses. So that's sort of profit, right? And the corporation pays taxes at rate tau on that difference between revenues and expenses. That's their sort of pre-credit tax liability. Corporations are eligible for some tax credits, sort of like the child tax credit or the earned income tax credit right on the individual side. There are corporate analogs, such as the research and development tax credit. There's some manufacturing credits. There used to be an investment tax credit. Those credits offset tax liability dollar for dollar, right? So if we allow a firm to deduct an expense that had not previously been deductible, suppose we let them deduct an extra dollar of expenses that they couldn't previously deduct, how much do they save on a dollar of now deductible expenses? They save what fraction? Tau, right? So if they get to deduct an extra dollar of expenses, they're going to save, if tau is 35%, they're going to save 35 cents on that dollar from allowing them to deduct that expense, right? Suppose we give them $1 of tax credits. How much are they going to save? $1, right? So just like with deductions versus credits, allowed expenses are worth less than credits are. Question up front? Yes? The whole thing? Okay, so profits of the firm are the difference between revenues and expenses. The corporation owes taxes on that profit, right? So revenues less expenses times tau is the pre-credit tax liability. That tax liability is reduced by any credits the firm has earned dollar for dollar, right? So $1 of tax credit offsets a full $1 of tax liability. So credits that they may be eligible for on the corporate side include the R&D tax credit, previously the investment tax credit, and some credits. There are miscellaneous other credits for energy production, energy research investments, manufacturing credits. There are various other credits the firm might be eligible for. So I just want to point out that allowing the firm to expense another item saves them cents on the dollar, while a tax credit offsets tax liability dollar for dollar, right? So credits are more valuable than newly deductible expenses. What expenses can be deducted when we say, they deduct expenses from revenues? What am I talking about? I'm talking about per period things like wages or supplies, rent they pay, lease costs. It also includes interest payments on debt. So if the firm has borrowed money from a bank or from bondholders, they can deduct that interest cost from the revenues. And finally, it includes something we call depreciation allowances. So I want to talk about depreciation for a minute. So when you hire a worker and you pay them a salary for a year, that labor supply is provided to the firm for that year, and then it disappears, right? Then the labor supply has been provided, and that's done. But when you buy, let's say, a plane, do you typically toss a plane after a year? Brand new plane? No, right? Planes are durable goods. They're long-lived. Let's say a plane lasts for 20 years. The cost of that plane to that firm is the difference between what they paid for the plane when they bought it and what that plane is worth at the end of the year. That's the depreciation amount. It has nothing to do with the IRS. It has to do with the molecular structure of the plane, right? It has to do with how well this plane lasts over time. It could have to do with technology, right? In the case of computers, right, when you buy a computer today, a computer may work for 5 years, but its economic life is less than that because the value of that computer in a year is much less than 1/5 of its value, right? It loses value very quickly. And that's because for the same $4,000, if you buy a computer today for $4,000, next year $4,000 will buy you far more computer, right? Because there's this technological improvement over time. So your same computer has lost value simply because other computers have gotten better. So that's one way, right? That's still economic depreciation. This is how the thing you've bought loses value over time. It's intrinsic to the nature of that thing. It has nothing to do with lawyers. It has nothing to do with the IRS. It has nothing to do with anything. It has to do with just the properties of this item. Another reason computers sort of obsolesce faster is that, has anyone had like an old iPhone and tried to put the new OS onto it? The newest OS. Does that always work super well? Sometimes it's sort of problematic, right? Suddenly this app is screwy and something goes wrong, right? It's because one of the ways computers obsolesce is that older computers can't run new software as effectively. And so the computer becomes less and less productive because sort of the complement good to it becomes less useful with it. So yeah, but all of this economic depreciation is about the very nature of the product. That's like the thing itself. The IRS understands that some goods are long-lived, and they're not going to let you deduct your $20 million plane all this year because you're not going to use up the plane this year, right? You're going to keep this thing on your boat, or you're going to have this plane for 20 years. They're going to let you deduct some fraction of that cost this year. If they went with economic depreciation, they would figure out, they would task a team, they'd run a study as to how this thing loses value over time, and they'd let you deduct that amount every year, right? It would be based on the nature of that item. Other ways depreciation allowances could be constructed is in a more accelerated way. There's economic depreciation, which reflects how long you're going to actually own that good, right? But they may give you something a little bit faster than that. So that, if we allow you to take the depreciation allowances faster, the depreciation allowances are worth more or less. More, because suppose we had a $6,000 piece of machinery. Suppose I let you take $2,000 a year over 3 years. There would be some PDV for that, right? Suppose I let you take $3,000 a year for 2 years. The PDV for that would be a higher number, right? Because you're discounting it less. You're taking bigger deductions earlier on. That number, the PDV of that number will be a higher number. So they might let you accelerate depreciation, allow you a larger PDV of the depreciation allowances, either because there's some uncertainty about the life of this good and they want to err on the side of the taxpayer, right? Or that they actually want to gin up demand for capital goods and sort of make this good cheaper. And that's what we're going to talk about today, is how depreciation allowances change the cost of capital investment for firms. Okay, so that's deductible expenses. It's cash flow costs, salaries, rent, leases, it's interest paid on debt, and it's depreciation allowances. The depreciation allowances is what the IRS lets you deduct as expenses each year. Depreciation itself is what we call delta in these models. It has to do with the actual product. It has to do with the molecular structure of the plane you bought, right? It has to do with how computer technology changes. Delta is all about the economic depreciation, a property of the actual product, while depreciation allowances are set by the IRS. Okay, what are tax credits? These are tax credits, like I talked about, like the R&D tax credit. It could be manufacturing tax credits. There's various corporate tax credits that some firms are eligible for. Prior to 1986, we used to have this thing called the investment tax credit, which you got for every dollar of investment. So if you made $1 of investment, you had to deduct some fraction of that as part of your expensing, your depreciation rather. And then you also got a tax credit for, say, 10 cents of every dollar you spent on investment. Awesome. Okay. And when it comes to the rate structure of the corporate income tax, Gruber has a chart that shows that there is some progressivity to the corporate income tax. Small businesses that are incorporated do pay rates lower than 35% on their marginal dollar of income. But every firm you've heard of, their marginal statutory rate is 35%. It goes to 35% very quickly. And you can look at that graph to kind of see where the cut points are. Okay, so let's get back to depreciation allowances. So economic depreciation, remember, is what's actually happening to that product. It's about the product itself. But it's actually very hard to know true economic depreciation for most things, right? It would take an enormous number of studies, and there's a lot of uncertainty about it. So the government generally uses two forms of depreciation allowance sort of calculation. One is straight line. Straight line just means we take the cost of the thing. We've run some study that gives us a rough idea of how long this thing should last, and we divide that number by the number of years. So if you buy a $20,000 machine and the government thinks this machine generally lasts 5 years, straight line depreciation would give you a $4,000 depreciation allowance each year for 5 years. What would the PDV of that $4,000 per year over 5 years be $20,000? No, be less than that, right? Because of the time value of money. Another way the government could sort of structure the depreciation allowances is that they might choose to accelerate it, right? Partly because, like I said, computers lose value very quickly, right? You wouldn't straight line depreciate a computer. It falls very quickly in value. For a good like that, they might use front-loaded depreciation allowances, right? Also known as accelerated depreciation. Where, say, you buy a $5,000 computer, they might let you take $3,000 of depreciation the first year, $2,000 the next year, and $1,000 the last year. right? They're front-loading the allowances to reflect the way this good loses value. Another reason I said you might accelerate depreciation is that you want to gin up demand for capital goods. We'll talk about why increasing depreciation allowances or accelerating them increases demand for capital goods in a minute. But we often do enact those kinds of policies during recessionary periods because manufacturing tends to be hit harder during recessions than other parts of the economy. And one way to sort of support, what is manufacturing? Manufacturing is the building of durable goods, right? That's what manufacturing is. So one way you can sort of help manufacturers is by increasing demand for durables. And increasing the depreciation allowances firms are allowed is one way we do that. Okay. And the key is that the present discounted value of depreciation allowances rises with the speed at which those allowances are allowed to, are the firms allowed to take those allowances. Okay, let's do a couple calculations. Let's imagine we're buying a $200,000 piece of equipment. K is just the value of the piece of capital. It's $200,000. The life of the asset, the true economic life of this asset is 10 years. The interest rate we're going to discount at is 8%, and the tax rate is 35%. So let's first just do a straight line depreciation schedule for true economic depreciation. Let's say the IRS allowed you to take depreciation allowances according to straight line depreciation with a time horizon that is equal to the economic life of the product, right, of this asset. So that would be 10 years. So it's going to take so the government's going to say it's a $200,000 thing. It's going to live for 10 years. You can take $20,000 a year for 10 years. But we know that the PDV of those depreciation allowances is not $200,000. We know it's something less than $200,000. How much less? We'll have to calculate it. So calculating depreciation allowances, we're going to take K divided by T. That's the amount per period we can take, right? That's the 20,000. That's 200,000 divided by 10 is 20,000. And we're going to discount for each time period from 1 to 10. Notice I start this at 1. We could have started this at 0, right? It just depends on how far away tax time is from purchase time. If I buy this asset on January 1st and I file my tax return and get my tax benefit on December 31st, we're going to discount even the first tax deduction, the first expensing amount, the first depreciation allowance by 1 year. Suppose I buy the thing on December 31st and I file my taxes on December 31st, then I get the first depreciation allowances without discounting, right? It just depends on whether a year passes between when I buy the thing and when I first get my first depreciation allowance. I'm assuming here I'm buying this good on January 1st, but I'm filing my taxes on December 31st. So even the first depreciation allowance of $20,000 has to be discounted at 8%. Okay, so when we do this PDV, you guys are all familiar with PDV, we're going to take 20,000 divided by 1.08 for the first period, right? That's the first year's allowance. The second period, we're going to square 1.08, so divide 20,000 by 1.08 squared, and then to the third, to the fourth, all the way until we have 20,000 divided by 1.08 to the 10th. 20,000 divided by 1.08 raised to the 10th is the present discounted value of the last depreciation allowance this firm will be allowed to take related to this asset, right? So we're going to sum that all together, and it turns out, when you build a little Excel spreadsheet, that number turns out to be $144,938. So discounting cost us roughly $55,000, right, versus the nominal amount of $200,000. This amount, roughly $145K, is the present discounted value of the depreciation allowances the government allows the firm to take. The fact that they get to reduce their income by that amount will reduce their tax burden, right? Because remember, what did we say, how you calculate corporate taxes? You take revenues, you subtract off expenses. You multiply that difference by tau, the tax rate, and then you offset some of that with some tax credits. So for every dollar of expenses I allow this firm to take in the form of depreciation allowances, how much am I reducing their tax burden? What fraction of a dollar? 35% tau, right. So when we think about how much this is worth, let's think about the real cost of the asset, right? The real cost of the asset initially was $200,000, but we're reducing the cost by allowing this firm to take these depreciation allowances. How much are we reducing the cost? What is their tax savings from these depreciation allowances? The tax savings is the product of the PDV of the allowances and the tax rate tau. So the $200,000 asset earns the firm depreciation allowances worth $144,938, right? Which saves them that amount times 35% in terms of taxes. So the cost of this item after tax is $200,000 less the product of 35% and $145,000. So it turns out to cost the firm roughly $149,000 after tax. Is it clear to everyone why I multiply the PDV of the allowances by tau here? Yeah. Okay, good. Okay, let's say the government, looks at the recession. They say, you know what, we're looking at the, yeah, question.
Sorry.
Yeah, of course.
So the 149,000 is what is the allowance amount?
No, the allowance amount is 144,938. That's the PDV of the allowances.
Right. Then what do they get taxed on?
So they get taxed on the income they earn from this thing. That's on the other side. So when we look at this, forget the revenues are linearly separable, right? So just put tau times revenues over there to the side. What we're allowing them is new expenses, right? We're allowing them to deduct extra expenses. Leave the revenues unchanged. We're allowing them to deduct some expenses. And for every dollar of expense we let them deduct, right, they saved 35 cents.
So if they bought it last year and this depreciation allowance wasn't in place,
Mhm.
they would have only gotten the benefit of the tax expense, of the expense for that item last year and then nothing this year. But this year, then it allows them to raise their expenses.
Exactly.
Profit.
Suppose we didn't have, suppose it was some good that we thought, there's no depreciation allowances for that thing. They would get no tax savings from using that item. No problem. Good question. Yeah, so the roughly 145,000 is the value of the allowances. That saves the firm 145 times 35% in terms of taxes. And so the $200,000 cost of the item is reduced by that amount. And so the after-tax cost of this item is only $149,000. Okay, let's say the government looks at the recession that we're kind of going through and they say, you know what, manufacturing is still not doing that well. Let's go ahead and allow for accelerated depreciation of capital goods. Capital goods are just durable goods. So they say, we know this thing costs $200K. We know this thing actually lives for 10 years. Its economic life is 10 years. Same assumptions. Interest rate is 8%, tax rate is 35%, but we're going to allow the firm to depreciate this asset over 5 years. Economic depreciation hasn't changed, right? Economic depreciation is about how this stuff wears out. That has not changed. That's what we'll later on call delta in our model. Delta is untouched by the acceleration of the depreciation allowances. All that's going to change is the present discounted value of the allowances, right? This is a tax change. It hasn't changed the nature of the asset itself. So when they allow accelerated depreciation, in this case they're going to say go ahead and straight line depreciate this thing over 5 years rather than 10. How are we going to get the new amount? Well, we're going to take k and divide by the new t, which is 5. 200 divided by 5 is 40, right? So it's $40,000 a year over 5 years. The first allowance comes a year from now, right? So we can discount that by 1.08, divide by 1.08. The next one is 40,000 divided by 1.08 squared, et cetera, all the way until the last depreciation allowance we'll take on this item now, under the new accelerated schedule, is 40,000 divided by 1.08 to the fifth. That sum turns out to be 172,845, which is higher than 145,000, which is what you got before, as we'd expect. I'm going to pause for a second. Yes, Siobhan?
So, okay,
Yeah.
the 139,000, that's what the real cost of the asset is after all of
After the tax savings from depreciation allowances.
So if you were to ask, well, what is the actual allowance, you would take the 200,000 minus 139? Is that?
No,
is that
no. Okay, let's go back. The PDV of the allowances is this, is 172. Okay, because I mean, just note for the exam, I know there's a lot of stress about formulas and all kinds of stuff. The key to this exam is logic. Like, you don't need to memorize 50 things, right? So what is the value of the allowances? It's going to be the thing called the PDV of the allowances, right? Just remember, what are we talking about? We're saying, okay, the firm is letting me deduct some fraction of this thing's cost every year, but I know that I can't just add up those numbers because it's over many years. I have to discount. Okay, so for me to get the value of this tax savings from these allowances, I have to do this little calculation, right? That's all this is. This is just saying what's the value of those allowances. It's the present discounted value of the allowances is roughly $173,000. So the present discounted value of the allowances when we accelerate depreciation has gone up, right? The tax rate's the same, so we know the tax savings is higher now, right, from depreciation. So the net cost of this asset is now going to be $200,000 less 35% times 173,000, right? So accelerating depreciation has increased the value of the depreciation allowances and thus decreased the after-tax cost of this asset. When prices go down, what happens to demand for those things? Goes up. So by accelerating depreciation, what has the government done for demand for these kinds of goods? Increased demand for these goods, and thus increased demand for goods that the manufacturing sector creates. What's one reason why we might not necessarily increase demand for goods produced in Ohio and Pittsburgh and stuff? Where else is stuff made? Outside of the country. So when we allow depreciation on all capital goods, we could actually end up increasing demand for foreign imports, right? For foreign imported durables. So this is about all durables, right? So it's sort of a blunt tool to increase demand for U.S. capital goods, right? Okay. Okay. A little policy for you to keep it Wagner. Okay. Anyway, so that's straight. This is economic straight line. This is accelerated straight line. Let's say the government says, that's it. You know what? We're going to make this deal as sweet as it can be. You can deduct the full $200,000 this year. That's the best of all deals, right? Because what's the PDV of $200,000 this year? Right. So in this case, actually, so I've goofed a little. It should be 200,000 divided by 1.08 because we've always gotten the allowances 1 year after, right? Let's say we get immediate expensing so that the government lets you take it right now, right? They give you the check. They give you the right through the check now for the difference. Expensing means you get the full PDV, right? The PDV of expensing is the amount of the good. So $200,000. So what's the real cost of this good now? It's $200,000 less $200,000 times 35%, which is $70,000. $200,000 less $70,000, $130,000. Expensing makes this good cheapest of all. Okay, because this is, so I'm going to use a letter called Z in this class. Oh, this doesn't have a blank page, shoot. Oh, does anyone have a blank piece of paper by chance? Actually, you know what? It's okay. Well, it's okay. We can just do it on the slides. So we're going to use a term called Z, right? Z and from the Gruber textbook, he calls it Z as well. Z is nothing but the ratio of the PDV of allowances to the purchase price of the asset. So here, what would Z be in the case of expensing? What's the PDV of allowances in the case of expensing? What's the purchase price? So that ratio of the PDV allowances to the purchase price in this case with expensing is 1. That's the highest Z can be. Suppose I allowed you no depreciation allowances for something. What would Z be in that case? 0. In this case, Z would be 172,845 divided by $200,000. In this case, Z would be 144,938 divided by 200,000. So as we accelerate depreciation, Z gets bigger. Z gets closer and closer to 1. The slower the depreciation schedule, the closer Z is to 0. Z ranges from 0 to 1. Okay. That's sort of the story of depreciation allowances. I'm going to take a minute and talk about the incidence of the corporate income tax. So let's just think about first a tax on producers. In what case will consumers bear some of that tax as long as they are not? So we tax producers. Consumers will bear part of that tax as long as consumers are not, demand is not perfectly elastic. Right. Okay, so as long as both sides are somewhat inelastic, right, or somewhat elastic but not fully perfectly elastic, the tax levied on producers will be shared by consumers and producers. Right? Right. Okay, so part of the corporate income tax is going to be borne by people who buy goods from the corporate sector. What firms can't really bear taxes, right? Firms aren't people, only people pay taxes. What is inside a firm? What is a firm? A firm is an institution that combines labor and capital to produce goods, right? So the part of the tax that the firm or the producer is bearing will in fact be borne somewhat by workers and somewhat by capital, right? Returns to working in the corporate sector, so wages in the corporate sector will fall. The return to capital in the corporate sector will fall. So the tax will be paid by consumers, will be paid by workers and capital owners in the corporate sector. But if returns are lower in the corporate sector, what are workers and capital going to do? Leave the corporate sector and go into the non-corporate sector, right? What's going to happen to returns in the non-corporate sector as all this labor and capital comes flooding in? returns are going to go down. So the tax is also going to be borne by factors of production in the non-corporate sector, right? So it's borne by consumers, it's borne by the corporations, which means they're workers and they're capital owners, but it's also going to be borne by non-corporate investors through GE effects. Okay, this is all theoretical. We have no empirics on the incidence of the corporate income tax. There's not enough there's no state by time variation, right? There's no treatment group and control group, and there's nothing cute and pretty about the corporate income tax that lets us get the kind of clean variation we want to estimate the incidence. So it's an open question. We don't empirically know. CBO puts the entire corporate income tax onto capital owners. We know that's surely not quite true, right? Some of these other portions are gonna actually bear part of it, but they put the entire incidence on capital owners just for sort of simplicity. Because anything else is also a guess. They choose that particular guess. Okay, so CBO, remember, scores legislation. They come up with the tables that describe the distributive impacts of sort of proposed legislation. So their assumptions do matter somewhat, right? They affect sort of the debate in Washington. Okay, so now I want to talk about the first of two behavioral margins when it comes to the corporate income tax. We're going to talk about how the corporate income tax affects the amount of investment in the corporate sector, as well as how that investment is financed. So let's start with the amount of investment. So the way we're going to model this is we're going to think of the corporate income tax as reducing the marginal benefit of investment. Then we're going to start putting in the depreciation allowances and the tax credits, the investment tax credits, and that's going to partly offset the cost of investment, right? That's what we saw, that this whole calculation was about how depreciation allowances reduce the cost of investment, right? The initial cost of investment was $200,000. The tax advantages to investment, right, the depreciation allowances, reduce that cost somewhat. So first we're going to layer in the corporate income tax, which is going to reduce the benefit to investment. Then we're going to put in the tax benefits to investment, right, the tax advantages, which is going to reduce the marginal cost of investment. And it'll turn out to be true. So the new equilibrium will be between the new marginal benefit curve that reflects the corporate income tax and the new marginal cost curve that reflects depreciation allowances and tax credits for investment. That combination of new curves will give us the new equilibrium level of investment. And it's actually theoretically true that you could end up with a combination of corporate income tax levels, depreciation allowance generosity, and investment tax credits that are such that the cost of capital after tax is actually lower than pre-tax, i.e., the net effect of the tax system is a net subsidy on investment. And in fact, we did see that in the 80s. And we'll talk about exactly what would have to be true for that to be true. Okay, so let's go back to economic depreciation. Remember, economic depreciation is about the thing itself. It has nothing to do with the tax code. That is what we call delta. So for this discussion, for this model of investment, don't think about machines. I want you to think of each dollar of investment buying some kind of clay. Anyone heard of putty clay models in economics? No. Okay. But so the reason I'm going to tell you to think about investing in clay is that when I take $1's worth of clay in my left hand and $1's worth of clay in my right hand and smush them together, how much clay do I have? $2 worth of clay, right? It doesn't sort of combine and become $1.60 in clay. It doesn't somehow combine and become $2.20 in clay. It's just, you can add it onto each other, right? You can slap another $1 worth of clay onto this pile of clay. So that's the way I want you to think about it. Because we're not going to talk about machines. We're going to talk about dollars of investment. So we're going to be buying $1 increments of clay. That's our investment. And you can think that, when I buy $1's worth of clay today, at the end of the year, I only have 90 cents worth of clay. Maybe the outside gets crusty and I have to cut it off or something. But sort of part of this clay depreciates and disappears over the year. The amount of clay that I lose over the year is delta. So I buy $1's worth of clay, I somehow lose 10 cents of clay over the year. It dries out, it becomes crappy, something happens to it. That's delta. Delta, remember, is about the actual nature of the clay. It has nothing to do with lawyers or the tax system or anything else. And then I have this other term, rho. So suppose I want to buy $1's worth of clay. Let's say I don't have $1. I have to go procure $1. I can get a loan from a bank or from a bondholder for that $1, right? Or I could go sell a share in my business for $1 and get $1. I could also be a firm that has retained earnings, right? That has cash on hand in the firm. I could get the $1 from my own coffers. All of these cases have a cost. So in the case of a bondholder, what's the cost of getting $1 from a bondholder? You have to pay him, starts with an I, interest. In the case of an equity holder, he's going to either want a dividend or he owns a fraction of my firm, right? And he's going to get a capital gain increase from this investment. In the case of retained earnings, when I pay for this $1 worth of clay investment with my own funds, is that free? No, right? Because there's an opportunity cost to putting this $1 into clay investment. What's the opportunity cost? The interest I could have earned on that $1 by investing it elsewhere, right? By investing it in the stock market or in another project of some other investment, right? So no matter where I get the $1 to buy the clay, it has some cost. And we're going to call that cost rho. In particular, I'm going to assume that we're using equity financing, and I have to pay rho cents for every $1 I get. I have to pay rho cents in dividends to my equity holders each period. It's a simple assumption I'm going to make, so we just have a concrete idea of what this is. So when I buy $1 of clay, the cost of acquiring that $1 of clay, or owning that $1 of clay for a year, is the fact I lose 10 cents of clay from just owning this thing. That's the depreciation. Plus I have to pay 10 cents or 8 cents in dividends for each $1 of equity investment to my equity holders. So the marginal cost of $1 of investment is the sum of delta and rho. It's delta plus rho. That's the marginal cost of investment. Why do we invest? Because there's some benefit, right? In fact, the benefit, we have a special term for the benefit to investment. It's the marginal product of capital. It's the return from one more increment of investment, one more $1 of investment. We call that MPK, marginal product of capital. What I'm saying is buying $1 of clay gives me MPK worth of additional output. That's the marginal product of capital. In all production functions, you talked about in micro, and that we'll talk about here, all production functions that we talk about have this feature called diminishing marginal returns, right? That simply tells us that our fifth worker is less productive than our first worker. Our 10th unit of capital is less productive than our second unit of capital. They all give us positive outputs, but less and less so as we acquire more capital or hire more workers. That's diminishing marginal returns. That tells us that the marginal product of capital is a decreasing function of capital. The more capital we have, the less productive the marginal unit of capital is. So as K increases, MPK falls. So MPK is going to be a downward sloping curve. The marginal benefit with no tax in place is simply the marginal product of capital. But let's say we levy a corporate income tax, such that each unit of output is taxed at some rate, right? At tau. Or each, let's say the output is sort of is profit, right? So the marginal benefit falls from MPK to 1 minus tau times MPK, because tau times MPK is the check we have to write to the government at the end of the day. Okay, let's go ahead and look at this graphically. So marginal cost is delta plus rho. Notice delta is true for every $1 of clay I buy. I'm going to lose 10 cents of that clay. And we are a small firm, so our dividend payout doesn't have to rise with how much we're trying to finance. Whether we're borrowing $1 from equity holders or we're trying to borrow $10,000 from equity holders, we still only have to give them rho per $1 of investment. So notice that the marginal cost is flat, right? It's constant. It doesn't change with how much capital we have or how much investment we make. So the marginal cost curve is just a horizontal line at delta plus rho. Our marginal benefit curve, let's look at the blue one. Like we said, the marginal benefit pre-tax is simply the marginal product of capital. And it's going to be this downward sloping line because the marginal product of capital falls as capital increases. So it's high when we have low levels of capital. It goes low. It gets much lower as we have more and more capital. Okay, then we levy our tax. So our marginal benefit curve goes from MPK to 1 minus tau times MPK. Say tau is 35%. That means our new marginal benefit curve is 0.65 times MPK. It's a proportional shift, right? So we're going to get this rotation of the curve, right? It's not going to be a parallel shift because we're multiplying by a fraction. It's going to sort of rotate. So the red curve is our new marginal benefit curve. Remember, equilibrium, the optimal level of investment, is where the marginal benefit of investment equates the marginal cost of investment. Originally, that happened at some capital level K1, where the marginal product of capital was 20 cents, what the marginal cost was. This particular example assumes that delta is 0.1 and rho is 0.1, so the marginal cost is 0.2. So when the marginal product of capital was 0.2, was at level K1, and that's where our optimal level of investment was. Then we levied the income tax, and we shifted our marginal benefit curve. We changed our marginal benefit curve. But the new capital level has to have a marginal product of capital high enough such that the after-tax marginal benefit is equal to the marginal cost, right? Because the marginal cost is still 20 cents. The MPK must rise to offset the fact that we only get 65 cents on every dollar of MPK. Because 1 minus tau times the new MPK has to be equal to the same 20 cents, right? If tau goes from 0 to 30.35, it must be true that the new marginal productivity of capital must be higher. We know the marginal productivity of capital at the new equilibrium is higher than the old one. Because marginal productivity of capital is declining in capital, we know that the new level of capital must be lower than the original level of capital. And that's exactly what we see. We see a K2 to the left of K1. Does that make sense to everybody? Okay, good. Okay, so we've levied the corporate income tax here, but we have not taken into account the fact that the IRS lets the corporation deduct depreciation, right? We've not taken depreciation into account. That's the next step. Without tax advantages, so without depreciation allowances and without an investment tax credit, the marginal cost of capital is delta plus rho. Remember, delta is about the thing itself, it's economic depreciation. We're going to allow this firm to take some depreciation allowances. We're going to pick a depreciation schedule, right? And that firm's going to be allowed to depreciate that dollar of investment according to some timeline. Remember Z? Z is the ratio of the PDV of the depreciation allowances to the purchase price of the item, to the cost of the item, right? Z was PDV of allowances divided by cost of item. That was Z. The higher Z was, the more generous the depreciation schedule, right? The more accelerated it was. So the tax benefit to a dollar of investment, right? If you're allowed to deduct depreciation allowances such that you get to sort of save Z cents for every dollar of investment, the tax savings from the depreciation is going to be Z times tau, right? For a dollar of investment. Does that make sense to everybody? Okay. Alpha is the investment tax credit per dollar of investment. So that's like for each dollar of investment, you get some tax credit of 10 cents. Okay. So this is going to make our marginal cost. Our marginal cost was originally delta plus rho. Each dollar, right, of investment costs delta plus rho, but we get delta plus rho times Z times tau in terms of tax savings from depreciation allowances, right? Because Z times delta plus rho is the value of, is what we get to deduct in PDV terms, and then we multiply that by tau to get the tax savings. Okay, and we get alpha plus dollar investment, so alpha times delta plus rho is the tax savings from the investment tax credit. This is the new marginal cost. You can see that it's lower than the original pre-tax advantages marginal cost. So let's reflect both of these changes in our graph. So the marginal benefit curve has gone from MPK to 1 minus tau times MPK. That was the last thing we did. But now we're actually going to reduce the marginal cost. The marginal cost is going to fall from delta plus rho to delta plus rho times 1 minus tau Z minus alpha. So the higher is Z, the lower the marginal cost, right? The higher the PDV of allowances relative to the cost of the item, the lower the marginal cost of purchases. That was simply what we saw when we saw accelerated depreciation before we did the calculation. We saw exactly that. Okay, so when we went from no taxes whatsoever to having just the income tax but no tax advantages to investments, we went from K1 to K2. Then we're going to introduce depreciation allowances and the investment tax credit, shift the marginal cost curve down to MC2, and we're going to get an equilibrium level of K3, equilibrium level of investment of K3. Because this means that the tax advantages of investment, so the depreciation allowances combined with the ITC, partially offset the corporate income tax, but don't fully offset the corporate income tax. How do we know that it doesn't fully offset the corporate income tax? Because we're at a K3 lower than K1, right? We've still reduced investment. And that's what tells us there's a net tax on corporate income. The effective tax rate on corporate income, or on firms, is in fact the new MPK less the old MPK divided by the old MPK. So it would be the old MPK at C, the new MPK at C, which is what? 14.5, right? Less 20 cents divided by 20 cents. That's the effective tax rate. So it would be 20 cents divided minus 14.53 divided by 20 cents. The effective tax rate here is positive. There is a tax on this good. Because we know that the K level is lower than it was before. Okay, so there can be a combination. So someone can guess this. Give me values for Z and alpha such that we'd get a K3 greater than K1. What's a good Z to guess? What's the high? We need Z to be really high. What's the highest Z can be? Which is expensing. In the case when we allow for expensing, and we have an alpha greater than 0, so any investment tax rate at all, we'll get more investment than we did in the no tax equilibrium. We'll get a K3 greater than K1 in that case, because the effective tax rate will be negative. Okay, so this is all theory. Any questions about this? Let me actually stop for a second. I'll drink some water and you guys can mull this over for a second. So the reason the effective tax rate is related to the difference in marginal product of capital is how the marginal product of capital has changed is a measure of how distorted this market is, right? Because the only way to get a higher marginal product of capital is to do what? Invest less, right? Because it's a decreasing function of investment. So the effective tax rate is going to be a function of the change in marginal productivity because that's a measure of how distorted this market is by the fact that by the combination of the income tax and the tax advantages. So as we said, you could actually end up in a situation where the effective tax rate on corporate investment is negative. And we actually had that for some time in the 80s. For some time in the 80s, particularly certain classes of investment, so investment in sort of manufacturing type inputs or output could actually be negative. So the government was net subsidizing that type of investment. Okay, that was all theory. And you can use these analytical tools to kind of calculate the difference in investment, right? But what about empirics? There have been a lot of studies on this question. It's a popular question, right? How do taxes affect investment? And it seems like the consensus estimate is roughly 0.5, that a 10% reduction in the effective tax rate on capital will increase investment by 5%. There are some newer studies that suggest some lower numbers. There's some newer studies that suggest some higher numbers. The consensus estimate is roughly 0.5. Okay, so that's the end of how taxes affect the level of investment. Remember when we modeled this stuff, we were talking about $1 increments of investment, right? I think there's some sample problems on the practice exams where we're talking about like an item, like an actual good that's worth a certain amount of dollars. So I would love for you guys to look at this model and look at those sample questions and sort of see how having a value to the item, right, to having machines that cost $20,000, say, sort of changes the math but doesn't change the concepts, right? I mean, it doesn't change the math much, but it goes from $1 to like a large number of dollars per investment. So just, if you can make that change flexibly, you really understand the model. Okay, so let's go ahead and talk about how the structure of the corporate income tax can affect the way corporations choose to finance their investments. Okay, so let's just sort of think about where companies get money, right? So they want to, let's say the firm has a project. It needs to make an investment, and it needs $1. It wants to finance an investment, right? It needs money for this investment. So the firm wants to finance an investment. It has two ways it can finance this investment. It can go out and try to raise money from other people, or it can use its own funds, right? Its own funds are what we call retained earnings. So it can go to the market and try to get money, or it can use its own money. Remember, both of those things are costly, right? Investors require return. When you invest your own money, you're foregoing the return you could have otherwise earned investing it another way. Let's say the firm doesn't have enough retained earnings or doesn't want to use its own retained earnings, is going to go to the market and raise capital for this investment. It can do that one of two ways. It can issue bonds or go to a bank, right? That's debt financing. The second way is to issue stock, which is equity financing. In the case of going the debt route, we know that bondholders are going to get interest payments, right? Interest dividends or interest payments from the firm. Per period, they have to make those interest payments each period, right? If the firm fails to make its interest payments, what happens to the firm? In very simple terms? They default, right? Big, big trouble. In terms of equity, right, the firm can pass out returns to its shareholders in one of two ways. It can pay shareholders a dividend every period, but can the firm not pay the dividend? Suppose it's having cash flow problems. Can they renege on the dividend that term? Yes, nothing happens, right? There's no default when it comes to equity dividends. The other way the firm can sort of transfer the returns to the owners of its equity, right, its equity holders, is through just capital gains, right? So to kind of make ideas more concrete, imagine there are 100 shareholders of a firm, and they each, they all made an investment. They all bought shares and they made an investment. Let's say that project returned $100. The firm could pass out $1 of dividends, right, to every one of its shareholders, right? Take the $100 of return and pass out $1 of dividends to each one of its 100 shareholders. The other thing it could do is keep the money in the firm. Let's imagine capital markets are perfect capital markets, and they value things perfectly. If the firm has gained $100 of income and has kept it in the firm, how much more is the firm worth? $100, right? And how much is each of those 100 shares worth? How much more? $1, right? So the firm can either pass out, in very simple terms, the firm can either transfer that $100 to its equity holders by passing out a dividend of $1 to each of them, or just letting the value of the share go up by $1, right? Okay, so the basic idea of where firms get financing. Now let's think about how taxes affect these various sort of financing sources. Let's say the firm needs $10 for an investment that's going to give them $1 worth of income. The return on that investment is going to be $1. Firm earns $1. Let's say the firm financed this project with debt. It's going to pass that $1 onto its bondholders in terms of interest. So the bondholders have sort of invested in this thing, and they're going to get the whole return themselves, right? So it's going to pass that $1 on to bondholders in terms of interest payments. What did I say about expenses? They included wages, they included depreciation allowances, and what else did expenses include? Wages, depreciation allowances. There's one thing in between those two. Interest. Interest is tax deductible from the corporate income tax. So the firm doesn't have to pay taxes on the interest payments it makes to its bondholders. So there's no corporate income tax in the case of debt-financed investments. So they take the $1 of income, send it to the bondholder in the form of interest payments, but then the bondholder has to pay taxes, right? They have to pay income taxes at the rate of the interest tax payment. Let's say the bondholders are individuals. How is interest taxed on the individual level? Anyone remember from Mitt Romney's return? Like regular income, right? Just like wage income. They pay ordinary income rates on interest income. So there's no corporate income tax, but you're going to pay ordinary income rates, which could go from anywhere from 10% all the way to 35%, right? Depending on what tax bracket you're in. Okay, that's the debt deal. What about equity? So the firm gets $1, right, in return from this investment. But if it was equity financed, dividends and capital dividends and all that are not tax deductible for the firm. They have to pay corporate income taxes on that $1. So the firm is going to pay tau sub C, tau sub corporate, on that $1. The corporate tax rate, let's say, is 35%. So the corporation is going to pay 35 cents of that $1 to the federal government in terms of taxes. They have 65 cents after tax left, right? They're going to try to distribute that. They have to distribute that to their equity holders, right? They can go ahead and send that out as a dividend. In that case, that 65 cents then goes to the equity holder, and they have to pay dividend taxes on that, right? What is the dividend tax rate now? 15%. So the total tax on that $1, right? That $1 becomes 65 cents inside the corporation. Then that 65 cents is taxed again at 15%. So the total sort of after-tax fraction of the $1 received by the equity holder is 1 times 1 minus tau corp times 1 minus tau div, right? Because 1 times 1 minus tau corp gives us the 65 cents, and then they're going to go ahead and keep 85% of that 65 cents, right? Okay, so it's 1 minus tau corp times 1 minus tau div. The other thing the firm could do, right, I said, is not pass with the dividend, but just keep the earnings in the firm and just let the share price go up and let their shareholders experience a capital gain, right? In which case, if someone decided to sell that share, right, they would pay taxes at the capital gains rate. What is the statutory capital gains rate? Anyone remember? 15% for most. Well, it's 0 if you're in the bottom two brackets, but very little capital gains are earned down there. It's basically 15%. So the statutory rates on dividends and capital gains are equal. I'll explain to you later why the effective tax rate on gains is lower, in fact. But the statutory rate is 15%. So we look at this chart. Debt, you avoid the corporate tax. Equity, you have to pay either dividend taxes or corporate capital gains taxes. And I've kind of given you this fact that capital gains taxes are lower. So it seems like that's the way to go, right? Gains are the way to go. In fact, if instead of paying out a dividend, if someone sold many shares of your firm, they could sell some fraction of those shares and make their own dividend, right? Suppose you have 100 shares of something. Rather than getting a dividend per share, you could sell some fraction of your shares and make your own dividend. But how would you be taxed on that sale? Not in terms of dividends, but as capital gains, right? So there's a tax-efficient way to even make your own dividends. So this is sort of how taxes affect financing decisions. Let's sort of back up a step. Let's just talk about debt versus equity. Debt is tax preferred to equity. And why is that? Because interest payments are tax deductible from the corporate income tax. You don't have to pay Tau Corp. Debt is taxed only once at the individual rate, while equity is taxed twice. So depending on the rates, right, you could imagine this being different if the rates were different, but we know that the top interest tax rate is 35%. Most interest income is earned at the 28, 33, or 35% tax bracket, right? That's where most interest income is. It's pretty heavily taxed. Let's say it was 35%. Let's just say all interest is taxed at 35%. So that's pretty high. But we know Tau Corp is 35%. 35% is always going to be less than 35% plus another tax, right? So debt is always tax preferred to equity. Debt is taxed only once, while equity is taxed twice, and one of those rates is typically 35%. Capital gains are tax preferred over dividends, so even within equity. The effective rate on capital gains is lower for one reason. When do you pay capital gains taxes? When those gains happen or when you sell? When you sell. And you could sell much later than when those gains happen. Suppose my share went from $10 to $11 this year, but I don't sell for another 10 years. Is my tax burden going to be $1? No. I mean, my tax, it's not going to be 15%, it's not going to be 15 cents, right? 15% of a dollar. It's going to be much less than that because I'm going to pay it way out in advance. Way out in the future. So the PDV of the tax burden is lower simply because you get to delay paying that tax. In fact, if my share went from $10 to $11, and I didn't just sell later, but I sold never, and so my estate passed to my heir, if we're below the estate tax amount, right, the exemption, no taxes will ever be paid on that capital gain, right? Yeah. So the effective capital gains tax rate is lower because of just the PDV, right? You can choose when you pay the capital gains tax. You can delay it into the future. Also, right now, we said that they're both statutorily 15%, right? That's right now. Historically, the statutory rate on capital gains has been lower than dividends because up until 2003, dividends were taxed like interest. It was taxed at the ordinary income rate, just like wages and stuff. Only starting in 2003 are dividends taxed at a lower rate to reflect the double taxation of that income. Okay. So when we think about let's talk about dividend taxes alone for a second. So we've seen there's some good empirical studies when it comes to the taxation of dividends. So in 2003, we started taxing dividends like capital gains. So we went from taxing it like ordinary income to taxing it at 15%. Most dividends accrue to people at the top of the income distribution. So you can think that the marginal tax rate on dividends fell from like 28, 33, or 35 to 15%. It was a big change in the dividend tax rate. A 2003 study by Saez and Chetty, Saez of your Piketty-Saez article you read. So they found that when we cut the dividend tax rate, a lot more firms paid out dividends, and firms that had been paying dividends paid larger dividends. So cut dividend tax rates, you get more dividends. In fact, they found that if your investors were more likely to be taxable, i.e. your investors were not non-taxable entities like pensions and stuff like that, you were even more responsive to the tax cut in terms of payouts, right? So that's exactly what we would expect to see. Where the tax change would have the biggest effect, we see more of a reaction. Okay, so cut the dividend tax rate, we get more dividends. There's also empirical studies that suggest that when we tax dividends more heavily, we see more debt use because the cost of equity financing is higher, right? So we see that too empirically. But do we care when we think about when we think as a country, right? When the government is sitting around thinking, what should the dividend tax rate be? Are they thinking about more or less dividends being paid out? Is that their key outcome of interest? What are we really what are we really worried about? Investment, right? Because investment, the more investment there is, the more productive workers are, the more wages go up, the more growth we have. So investment is the thing that the national policy is really focused on, right? I told you what happens to sort of dividend payouts. I told you what happened to like financing composition, but that's not getting at the real question of interest. And there is a story that has some empirical backup to it that suggests that when we cut dividend tax rates, we could actually decrease investment. Why is that? Well, think of it this way. There's a good fact that says that firms tend to invest more when they have more retained earnings. It's been shown in a few papers. So when they have cash, firms kind of prefer to finance investments out of cash on hand, out of their own money, versus money from going to the market, right? Whether it's debt or equity, they prefer their own funds. Remember, those funds aren't free, but firms tend to prefer those funds. What do dividends effectively do? They reduce retained earnings, right? Because the firm is paying out money to its shareholders. So when we cut dividend tax rates and firms pay out more dividends, there's less retained earnings in the corporate sector. And if we know from other studies that retained earnings is an important contributor to investment levels, cutting dividend tax rates could actually decrease investment. Of course, it's confusing as to why they actually prefer their own fund so much, right, versus the market. There must be some asymmetry of information that somehow the firm understands this investment better than the market does. Right? Okay, so let's do a quick question. So the top statutory tax rate on gains and dividends is 15%, but the effective tax rate on gains is lower due to A, taxation upon realization, B, step up of basis upon death, C, the investment tax credit, D, A and B, E, A, B, and C. Who thinks it's? Oh, we don't need to play that game. Any guesses?
It's actually circled on that slide.
Oh, is it? And they're on the same page, right? See, what I have to do next time is I have to do the one with the answer on the next page. That way it's sort of not right there. So it's A and B. And it's because I just said that there's realization. Both A and B delay the time of tax payment, right? So for PDV reasons, your effective tax rate is lower. The investment tax credit is neither here nor there. The investment tax credit doesn't change financing. What does the investment tax credit do? It changes the level of investment, right? It changes whether a project is worth undertaking or not. The financing is the next step. Okay. So when we looked at this chart, right, I kind of made this big deal about this stuff is taxed once, this stuff is taxed twice. Why do firms use debt at all? Why do we ever see firms? Why do firms ever use equity at all? Why don't we always see debt-only financed firms? Right? That's a question, right? The tax preferences are clearly for debt. Why do we have equity markets if debt is so tax preferred? Well, even though I hate to admit it, there are factors in decision making outside of taxes, right? There are things that affect how people live and do things besides taxation. For example, there are risk differences. So let's say you have a firm that's heavily debt financed, or you have a project that you're thinking about debt or equity financing. What did we say is true about missing an interest payment? Really, really bad, right? It's not good to miss a dividend payment. It's not a nice thing to do. It's going to affect the value of your firm. You're going to look a little less stable, et cetera, et cetera. But it's not as problematic as missing an interest payment, right? So if you have a risky project, let's say the stream of payments or stream of income from that project is going to be volatile, you might prefer equity financing because you don't want to undertake the risk of default, right? And that's partly because bankruptcy is a very costly process that's sort of asset destroying, right? If bankruptcy was a free and kind of you could come out of bankruptcy and be fine, this would be a different question. But it's because bankruptcy is sort of value destroying. Default is a real risk you want to avoid. And so having more debt just makes you more likely to default directly, right? That there could be an income stream that you have a bad year and you owe the interest payments nonetheless, you have to pay them, you'll be in default. But there's even a behavioral effect to being debt financed. So when a bondholder lends money to a firm for a project, suppose the firm does really crappy, what's the most the bondholder can lose? Whatever they lent the firm, right? That's the most they can lose. Suppose the firm does pretty well and can make their interest payments. Bondholders are happy, right? Suppose the firm does fantastically well. Do the bondholders care? No, because their upside is limited to their interest payment. That's all they get. Equity holders, right? What's the most they can lose if the firm does really crappy? Whatever they invested in the firm. But what if the firm does fantastically well? Equity holders have unlimited upside and a limited downside. The downside is only what they've put into the firm. But they have an unlimited upside. So equity holders have an interest in riskier gambles, right, than debt holders do. Because the debt holders have a limited upside. And if the equity holders hold a small share of the firm, let's say the equity holders only own 10% of the firm, 90% of the activities of the firm are debt financed, they have very little to lose, right? Suppose the firm goes under, they only lose 10% of the firm, right? So they have even less at stake and an unlimited upside. So the more and more of your firm that is debt financed, the riskier and riskier gambles the equity holders are going to want the firm to take. And while there are sort of covenants and some governance restrictions on debt, the shareholders sort of, are part of who helps appoint the board, et cetera, et cetera. The equity holders have a lot more say in how the firm is run, right? And so they could encourage managers to take some crazy gambles if they held a very small share of the firm. So suppose you want a loan, right? Suppose your firm is already 90% debt financed, you want another loan. A bondholder or a bank is going to look at your structure and say, yeah, your equity holders are crazy folks. They have incentives to go for crazy gambles. Your firm is not a good place to put my money. It's not a good debt investment. So there's a reason to have a mix to sort of have just for capital costs, right? To reduce capital. Jeff?
One thing to add is refinance risk, as we saw in 08. As your debt's coming due, you have to refi. If you're in a crunch like we were, then you're in a lot of trouble.
You're in a lot of trouble. That's a great point. And I'll, in fact, add that to the slide. Yes, refinance risk. So if you need to refinance and there's a credit crunch, you can't actually refinance. So debt is risky for a third reason as well. Okay, and the last thing I want to talk about is, when it comes to this. So we said, why do we ever see equity? And then within equity, we said, capital gains are tax favored. We have a lower effective tax rate. And I said you could, in fact, have your shareholders, if they own multiple shares, make their own dividends, right? By just selling off a fraction of their holdings, they can make their own dividends, homemade dividends, right? So why on earth do firms ever pay dividends? It just seems silly, right? It's like a tax waste. Well, there's a couple of reasons. One reason is that in most situations, right, the equity holders are a bunch of people, and they hire people to run the firm. They hire managers, they hire CEOs, they hire CFOs, they hire a bunch of people to run the firm. The incentives of the management are correlated with the sort of interests of the shareholders, right? They both want to make the firm a lot of money, but they're not perfectly correlated, right? There's stuff your managers want to do that your shareholders aren't really, don't want them to do, in fact. For example, the managers could effectively fly commercial airlines, but they might kind of like having private jets. So the managers really want the private jets. If, let's say, the private jets aren't actually more productive, they don't justify the cost, do the shareholders want the private jets? No, right? It's just burning cash. Management might like stuff like really stylish offices and really fancy curtains and trash cans and stuff. Do shareholders want that stuff? No. Who controls the accounting? Who really oversees the accounting by and large? Management. So unless you have an extremely good audit team, you may not even really know what your management is doing with cash in the firm. So you might actually want your firm to pay out dividends to just get the money out of the hands of those managers, to give them less money to play with. You could think, if they have a limited amount of funds, they use them productively. If they have excess funds, they go to town, right? Then you have crazy dinners and lunches and curtains and all kinds of stuff. So that's one reason, right? Do you want to get the money out of the hands of your managers who are sort of, maximizing their own private utility, but that's not quite your utility as the shareholder. The second reason comes from something in economics called the signaling model. So the signaling model is simply that some things are unverifiable, and you want to find a way to communicate something, and you signal. So let's think of an example. Let's say Matt and I are applying for the same job. Matt is an extremely good worker. I, on the other hand, am extremely unproductive. I sit around and surf the internet all day, let's say. But let's say, when he and I show up for the job interview, Matt's going to say I'm an extremely good worker, I stay on task, and I'm very productive. What am I going to say? I'm going to say I'm a really good worker, and I stay on task, and I'm very productive. Because saying that I'm a good worker is cheap. It costs me nothing to say it. I'm going to say it. But Matt wants to signal this potential employer that he is the better worker than I am. he has to find a way to signal that is more costly for me than it is for him, right? Because that's the way for him to do it and me to be unable to do it. Just saying it, we're both willing to say it. If I have a low cost to lying, right? If I don't really care if I lie, I'm fully willing to say it. So that's not going to work. So a costly signal that Matt could send could be something like a letter of recommendation from his previous employer, right? Matt is actually a good worker. So his previous employer, likes Matt, thinks he's a good guy, he's ready to move on, and so he's happy to write that letter. Or at least, it's costly to him in some way, but he's happy and willing to write that letter on Matt's behalf because Matt's a good worker. My boss, on the other hand, knows I'm a terrible worker, right? And for me to get him to write that letter, I probably have to bribe him, right? And that's more costly than Matt just asking his previous employer. So a letter of recommendation is differentially costly for me to procure than for Matt, and so that's a good signal for Matt to use to signal his quality, because it's far more costly for me to make that than for me to send it than for him to send it. Similarly, so dividend sort of in terms of tax efficiency is a tax inefficient way to send money out of the firm, right? We've talked about this. Instead of paying dividends, you could not pay dividends and burn a little cash, right? You could just light money on fire. It's a costly thing to do. But it's a way to signal the quality of your firm, right? Because it's like saying, we're so good at what we do, we can waste money on dividends. We are such a productive and a good place for your investment that we're going to throw money away on dividends. It seems dumb to throw money away, but it's a way for us to say we are that good a firm relative to these other bozos who can't afford to burn money because they need every dollar they can get to just basically meet costs, right? So it's a signaling model. It's a signaling model. Yep.
I would think also to a certain extent just investors like dividends.
But they could make their own dividends in that way. A capital gains is tax favored. Like it costs them money to get them. So yeah, it could be.
They may not be thinking of it that way.
So that would be an irrational investor who's not looked at the tax code.
I would think that would be
Maybe. I mean, I think
authority.
that's some kind of behavioral model that people just sort of don't know. Okay, I mean, especially, I could see your point, especially now, when the statutory rate is the same, right, and it's only the effective tax rate that's really different. I mean, I could see it more now than maybe before when people were paying 35 cents on a dollar of dividends and 20% on capital gains. Yeah, with the statutory rates being the same, I can actually see your point more. Okay, so we talked about this. Okay, so corporate code integration. I probably have talked about this before here. But this is the idea that we just instead of having these two tax codes on the individual side and the corporate side, we just get rid of it. We stop taxing corporate income. It's the removal of the corporation tax in order to include corporate income into the individual tax. Integration would do several things. It would remove the distortionary impact on financing decisions, right? Debt would no longer be preferred to equity, right? So it would get rid of the debt equity distortion. It would also remove the incorporation distortion, right? There's an incentive to not incorporate right now, right? But what would also happen? Well, there's some income that's taxed twice, right? Some income is taxed twice right now. So if we stop taxing it twice, revenues would fall. Also, there's a danger that suppose the firm never pays out the income. They could just retain the money in the firm, right? And if you never sell your and if you don't sell your shares, in that case, taxes could be avoided altogether, right? If ownership is just perpetuated. So if we really wanted to undertake corporate code integration, we'd have to do a couple things likely. We'd have to raise marginal tax rates on the individual side to make up the revenue lost from getting rid of the corporate income tax, right? Also, corporate income generally accrues to, it has, the incidence is shared by many, by labor, by capital, by consumers. We think a lot of the corporate income tax at the end of the day does fall on capital owners. So by getting rid of the corporate income tax, we'd reduce the overall progressivity of the tax code. So when we change individual rates, we may in particular want to make the individual code more progressive. We might want to increase the tax rates on dividend and capital gains income, right? If we have no corporate income tax, we might want to increase those rates. Second, we'd also, because of the idea that the corporations could just kind of keep the earnings in the firm in perpetuity, right? We'd probably want to do some kind of accrual tax. So even if you don't sell your shares this year, if you're invested in a corporate entity, you're going to be taxed on the change in the value. Maybe there's some smoothing to allow for liquidity constraints, but we would have to have some type of accrual taxation. So we'd get rid of taxation only on realization, have some kind of accrual taxation. Because otherwise, people could just stay invested in firms for a long, long time, borrow against those assets and sort of finance consumption without paying the tax on that income. But yeah, so this is a real, it's a tricky part, especially the accrual taxation would be tricky, but you've seen how corporate income taxes comprise less and less of our sort of tax pie. We've talked about that initially, right? That corporate income taxes are a smaller and smaller source of revenue, and the corporate income tax is not paid by every firm equally. There's been some notable examples in the news lately, and there's some argument that it's sort of paid by certain kinds of firms more than others. It's paid by older firms more than younger firms. It's paid by manufacturing firms more than service firms, and there are some arguments to just scrapping the whole thing altogether. Okay. So the last thing I want to talk to you about today is related to so it's very much related to sort of one of the motivations for getting rid of the corporate income tax, which is the declining share of revenues coming from corporate income taxes. And that is how we treat income earned by international corporations. So one of the effects of globalization is more and more US firms operate in many tax jurisdictions. They're earning income abroad. And that makes their income and their income taxes more complicated, and it gives them opportunities to minimize their tax burdens. So when we think of taxing international income, we can tax it in one of two ways. There's two broad sets of systems. One is a territorial tax system, in which a corporation earning income abroad pays tax to the government of the country in which the income is earned. So that's each country, you earn income there, you pay taxes there. It sounds simple. It's a little more complicated than that simple sentence, right? Because the tricky part to this is country in which the income is earned. What does it mean to earn income in a country? Does it mean you build the thing there? Does it mean you sell the thing there? Does it mean you came up with the intellectual property that sort of guided this product there? Does it mean you did the design there, right? Where it's earned is a tricky set of words to define. So territorial is not super simple either. But what the US has, and which many developed countries have, is called a global tax system, in which corporations are taxed by their home countries regardless of where their income is earned. So GE theoretically owes US taxes on every dollar it earns, regardless of what country it earns that money in. There are a few ways this is sort of made practical. A multinational corporation, which is just the way our label for an international firm, so a multinational corporation, an MNC, can claim a US tax credit for any taxes they've paid to foreign countries. So let's say GE has earned $100 million in China. Let's say it's paid 20% of that to the Chinese government, so they've paid $20 million to the government of China. The US corporate income tax rate, let's say the statutory rate is 35%. So GE owes, theoretically, $35 million to the US government, right? But you get a credit for any taxes paid abroad, so they get a credit for the $20 million. So they should owe the US government $15 million, right? That's the way that works. Under some circumstances, cross-crediting is allowed. Multinationals can use excess credits from one foreign subsidiary to offset US income taxes altogether in another one. So, we're a pretty high tax country when it comes to statutory rates, we're 35%. Most countries that operate abroad are actually facing lower taxes in those countries, either because their statutory rates are lower or because those countries have offered that corporation tax incentives to locate there. But there are situations where there are excess credits earned in some country for some reason that they've paid more than 35% in that country. They can use the excess credits from one country to offset tax liabilities on income earned in a different country. There's some limitations on that, but cross-crediting is allowed, cross-country crediting. But in principle, right, regardless of these two sort of practicalities, theoretically a multinational corporation should still be paying the US rate of income tax on income earned rather. It may not pay it all to the US, it's allowed to pay to other countries, but it should be paying in taxes 35% of what it's earned, right, in principle. And that's not what we see. And there are a few reasons for that. And it's primarily because there are tax advantages to international income. When we usually talk about tax advantages, we're talking about things like IRAs or accelerated depreciation, where there's a direct intention by policymakers to tax advantage that stream of income. I've never been sure whether we mean to tax advantage international income or it's just a happy byproduct of the way statutes exist right now. Originally. Now, there's plenty of people who like the way we tax international income and want to keep it in place, right? But, tax advantages to international income, intended or unintended, I'm not sure. One of them is simply like capital gains. It's the time value of money. So I said that, if GE earns $100 million in China, let's say it's paid $20 million to the Chinese government in taxes. I said they owe $15 million in US taxes. They don't actually have to pay those taxes until they try to bring the money home, until they try to bring it into US accounts. If they're willing to keep the money in China for 30 years, they don't have to pay the $15 million tax for 30 years until they decide to bring it home. Suppose they decide to leave it abroad forever, permanently, reinvest those earnings abroad, they don't ever have to pay the US tax. In the sense that in capital gains, we say tax upon realization. In international income, we say it's taxed upon repatriation when it's brought home. So this deferral lowers the effective tax rate on international income, on foreign income. So we think there's a lot of US earnings left abroad, permanently reinvested abroad. Permanently, not so permanently, let's just say invested abroad. We think it's about somewhere between $1.2 and $2 trillion of income is in foreign countries. So in 2004, as part of the American Job Creation Act of 2004, we created what was called a foreign tax holiday. So I said, most multinational corporations are big guys. Their statutory rate is 35%, right? We said, remember when we said you have to pay 35% of the difference, 35% of the income that you earned abroad, less any tax you paid to other guys? Yeah, right now we're going to give you a sale. We gave them a deal. We said, guys, bring it home. We want you to bring that money home because we know retained earnings are an important source of investment. In 2004, we had a recession, and it was a jobless recovery back then. We said, we want to create jobs. Let's let them bring this income home. Let them spend it. Let them invest. Let's create some jobs. So we said, bring the money home. Forget the nonsense about 35%. If you bring it home now, we're going to give you a deal. You can pay 5.25% of any income you bring home now. People brought income home, right? We put the sale on foreign earnings. People brought foreign earnings home. They had said they were permanently reinvested. Not so permanent at 5.25, right? They brought them home. We saw an influx of cash come to the US. Some empirical analysis later sort of doesn't necessarily show that a lot of jobs were created. One of the statutory requirements one of the requirements of the statute was that the firms couldn't use the cash they brought home to fund stock repurchases, so share repurchase of their own equities that boost stock prices. But money is fungible, right? So you can always say, we didn't use those funds, we used these funds over here, right? You could always, money is fungible, it's very hard to regulate how money is used. I would actually argue in some ways that restriction didn't always make a lot of sense, right? Because when you let the firm sort of use the money to make a stock repurchase, it sort of increases stock prices, right? It lowers their cost of capital over time. So if at the point in time that we had the foreign tax holiday, they didn't have good investments, right? They didn't have good investment targets. Maybe there was so much uncertainty about demand, they didn't want to invest in projects. They didn't want to use the investment right then. By sort of raising equity prices, it allowed them to maybe access that lower cost of capital in the future, right? So there's various ways to think about this, but at the end of the day, if the purpose of letting them repatriate their earnings at a lower rate was to create jobs right then, that didn't seem to happen, the empirical outcome of that is. Second reason international income is tax advantaged is the glorious field of transfer pricing. So transfer pricing is the idea that you are a multinational corporation, you operate in many countries, in many tax jurisdictions. Some are high tax countries, some are relatively low tax countries, and you're going to arbitrage tax differences to minimize your overall tax liability. In very simple terms, you're going to try to put your profits in low tax countries and your expenses in high tax countries. So this could involve something like the Google case, right? Where does Google invent its stuff? Most of its stuff? California, right? Here in the good old US of A. But they licensed that technology, that IP. They licensed that IP to their subsidiary in Ireland, which then, through things I don't even want to get into, sent the income through the Netherlands, then through Bermuda, and Google ended up paying not very much in taxes, right? This is all legal, right? This is all legal. It's the idea that, when you operate in more countries that have different tax rates, you have more of an arbitrage opportunity, and firms take advantage of that opportunity. Transfer pricing has to do with the fact that so you have two subsidiaries of the same firm, they're going to buy stuff from each other, right? So the subsidiary that creates the technology is going to license it to the subsidiary in China that makes the stuff, maybe, right? There has to be some price paid between the subsidiaries, right? You're going to try to make it seem like we're the low tax country located manufacturer paid a ton for that IP from the high tax country, so that the high tax jurisdiction has lots of costs, right? But there's a regulation. It's called the arm's length pricing principle, which says that your subsidiaries must book prices when you do the tax accounting for what your subsidiary is paid for IP or for goods or for inputs or for workers, whatever, that are the equivalent of what that subsidiary that sold those products would have sold them for to an unrelated subsidiary, to an arm's length, or to an unrelated firm, not your subsidiary, an arm's length transactions price. So if your subsidiary in Palo Alto is selling something to your subsidiary in China, they should charge the price that your subsidiary in Palo Alto would charge to another firm completely. But it's very hard to substantiate what those prices should be, right? Lots of these trades are for unique goods, or markets are thin. It's very hard to substantiate. And there is some room for sort of adjusting these prices charged between branches of the same firm or subsidiaries of the same firm, such that the tax liability on the whole firm is minimized. And that's called transfer pricing. Okay, so there's been a few sort of thoughts on how to reform this stuff. Shoot. Okay, so one of these things, remember, there's been a lot of rhetoric about we're going to end the tax break to companies that ship jobs abroad. It's like rhetoric we've all heard. I didn't know what that was for a while, which scared me. I thought, if I don't know, what is this? It means deferral. There's been some discussion of ending deferral, so that if you leave, right now, if you leave the money abroad, you don't have to pay the taxes, right? There's some discussion of limiting deferral, so that you owe the taxes regardless of when you bring it back. There's been some suggestions about limiting cross-crediting, and also just simply a limit on how much sort of transfer pricing you can do. If sort of, a non-transfer price adjusted tax liability would suggest that your tax liability was X, but post-transfer pricing your tax liability is Y. If the difference between X and Y is too big, you owe some tax on the difference between X and Y. That's sort of the idea. These are all proposals. We'll see when they become law, or if they can become law.